And good afternoon once again, options traders. Well, let's talk about the myth of mispriced options. And I wanted to talk about this because I just had a conversation with one of our traders who got caught in this loop where they say, hey, this option is trading at an implied volatility higher than historic, and therefore it's a sale. It's not quite that easy. And so why is that? Well, let's go find out. And as always, before we do, please be sure to click like and subscribe. It goes a long way into promoting the channel and is greatly appreciated. So let's first jump over to the E-Trade platform, and I'm in the quote screen. I'm going to use NVIDIA for this demonstration. And right here we can see the implied volatility in orange versus the historic volatility in blue. So notice that the stock has been trading somewhere around 35% volatility, but the current is just above maybe 45, 46. So you see this gap right here where the orange line is above the blue. That's not always true, sometimes it's below. But whenever the orange line, the implied volatility, is above the historic, sometimes traders say, oh, that's an automatic sale because it's higher than the historic volatility, and therefore it's trading too high. Well, that's not really true. This is the crowd's best guess, and there's usually reasons why volatility is high. So right now we can see that today is May 6th, and right here on May 24th, confirmed after the market close, they are releasing earnings. So that's probably a good reason why we're seeing this bump in implied volatility. People start to rush out there and buy calls or puts to speculate on earnings, and they start bidding up the option prices, and that's what's pumping up this implied volatility. But there's an even bigger point to understand about this connection between implied volatility and historic volatility. So the thing that you have to understand is that whenever we start talking about a mispriced option, it's really a relative mispricing. It can only be mispriced against something else, whether it's against the stock or another option, a different expiration. We have to compare it to something else. Now, yes, it is true that small mispricings occur often, but they won't net you any profits. Those mispricings aren't going to be so greatly out of line that they're pretty much guaranteeing you a profit. That's kind of the myth that traders have when they say that the option is trading with a higher implied volatility than historic. It's not necessarily all that big of a deal. Instead, you must find large mispricings if you're going to have any type of an edge. But then again, that raises another important question. We are looking at the average opinion. That's what the implied volatility is showing. And you have to understand that there are many possible outcomes with a single average. So for example, let's say a 40% volatility means it could be lower or higher than 40%. The crowd isn't necessarily saying that it's going to be 40%. They're just saying this is our best guess. It's the center guess, or the average, among a wide range of possibilities. This is really the key, that whenever we talk about averages, you really should be thinking of ranges. Don't get so hung up on a single number. Realize that there's always going to be variation around that. And the same is true with implied volatility. So for example, let's take a look at flipping a coin 100 times and counting the number of heads. We've talked about this example for various reasons in previous videos, but let's ask a question. What's the average? What would be your best guess as to how many heads we could expect? And then a more important question, how far away can we be from the average? That's really what you want to focus on. Not that we get exactly the average, but what kind of a range is there? So for 100 flips, we could go through and do a calculation. I'm not going to show it here, but it's a fairly basic calculation that would show our standard deviation is 5% for 100 coin flips. So in the stock market, we would call this standard deviation the volatility. So right here is the center. If these were stock prices, this would be the current stock price. And so we realize that there is a range of possibilities. That shouldn't be real hard to conceptualize. It should be very obvious that if you flip a coin 100 times, you're not going to get exactly the same sequence, but it's going to be close in terms of those proportions. Now this gray area here is the one standard deviation mark, which will occur about 68% of the time. And if you look, there's our best guess is 50 heads will show, but we see it could be as low as 45 or as high as 55, 68% of the time. Well, that's a pretty good range. But if we go out to the gray plus blue, that's 2 standard deviations, now we're talking about 95% of the time that our coin flip's going to land somewhere in this gray or blue area. And so now we're down to potentially 40 heads and as high as 60 heads. So yes, even though the average might be 50, and that would definitely be our best guess, if we had to give it a range, we would say that 95% of the time, we would expect somewhere between 40 and 60. So hopefully that's a little bit more of an intuitive way to show what's happening when traders are looking at implied volatility. Yes, it is reported as a single number, but you really want to think of it as a range. And the higher that volatility number, and or the longer the time until expiration, the wider that range can be. So just because the stock might be trading at 30% historic and the option's currently at 40 doesn't necessarily mean that it's grossly overpriced. It still might be within reason about fairly priced. So always remember the thing about market prices. The market prices reflect the average opinion of volatility. And having a rough idea of volatility isn't going to gain you any profits. You can't say, well, the stock is 30 and the option's at 40 and therefore it's greatly overpriced. Not true. That's just giving you the crowd's opinion. We need to get a much better or more detailed assessment than that, because an edge comes from having an opinion better than the market, not for having the average opinion. So to look at an option's implied volatility and to know it's wrong would require a crystal ball, showing that it's substantially different from a distribution of all possibilities. And remember too, statistically, that accurate predictions require similar past experiences. So how could we possibly say that this next earnings for NVIDIA, for example, is exactly the same as the last 10 or 20? They just aren't. Every single one is different. Every single day in the stock market is different. It's very different from saying we're going to flip a coin 100 times, or we're going to draw 5 cards from a deck of cards, because those are stable distributions. They never change. See, that's not true for the stock market. So the one thing to remember is that the implied volatility is the best guess at future volatility. Yes, there's going to be a lot of variation around it, but it's still your best guess. So whenever you see high volatilities, always remember that high volatility may be high for a reason. Just because it's out of line with historic levels doesn't necessarily mean it's high and that you should sell options, especially uncovered. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.